Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. Today we're covering a special tax break that's available if you have company stock in your employer's 401k plan. The assets held in your 401k provided tax-deferred growth opportunities, but when you begin taking distributions, you're paying ordinary income taxes. However, if you own publicly traded shares of your company stock inside of their 401k plan that are valued higher than what you initially paid, you have what's called net unrealized appreciation. And there's an opportunity to utilize a tax strategy to pay a lower rate when you ultimately sell them. But you have to be careful to follow the strict rules that the IRS imposes. To utilize the NUA tax strategy, you must first meet the following three guidelines. One, you experience a qualifying event or a triggering event, which includes separation from service, attaining age 59 and a half, or death. Second, the employer stock shares must be distributed from the plan in kind. And third, a lump sum distribution is required, which means all the assets, including the stock shares, must be distributed from the employer plan in a single calendar year, bringing that account balance to $0. To receive the NUA tax benefit, the stock shares must be distributed to a taxable account, for which you're going to pay ordinary income tax for the price you paid for the shares, but not on the amount it gained since you purchased it. When you decide to sell those shares, you pay long-term capital gains rates on the stock's NUA instead of the ordinary income taxes. Let's look at an example. Judy participates in a 401k plan and owns her employer's publicly traded stock as a portion of the plan's assets. She purchased 5,000 shares at $20 each back in 2014, but today the stock's worth $45 a share. She's age 61 and she's going to retire this year, so she wants to utilize this NUA tax strategy. When she transfers the stock shares into a taxable brokerage account, she'll pay ordinary income tax on the $100,000 cost basis in the year that she transfers the shares. The $125,000 of growth, however, that's taxable at long-term capital gains rates when she or her heirs decide to sell those shares. So in our example, after she transfers them to her taxable account, she immediately chooses to sell the shares. So in this case, she would have saved over $21,000 in taxes. So to summarize the NUA stock taxation, cost basis is taxable as ordinary income when the distribution takes place after a qualifying event. The NUA gain is taxable at long-term capital gains rates when the shares are sold. And post-distribution gains follow the same taxation as other taxable account assets. If you'd like to learn more or have suggestions for future topics, please feel free to email or call me. Thanks very much for joining.